the infinite banking concept is a process. Cooking is also a process. You picking who your chef is going to be for your financial menu here is going to be vitally important. Instead of using somebody else's bank, we're just going to use our own bank. We're going to create our own banking system.
We want to build these policies so that you can get the high cash value, so that you can practice infinite banking, so you can finance your cars, so you can pay your debt off, so you can do investing.
Welcome back, everybody. Another episode of Wealth Webinar. Happy that all of you are here, and I'm expecting a lot more of you because today, we're going to be talking about customizing a financial strategy around cooking. That's right. So to make this official, I actually have to get ready to do some cooking here. So let me put my apron on. Shauna was nice enough to allow me to use her Hello Kitty apron. But it's pretty important that I have the right garb on because, hey, listen, you got to get yourself in the right mindset when you're going to be doing things. Holy cow, how do women do this? You're supposed to tie this behind your back? All right, anyway, we're just going to tie a knot. Yeah, because I'm not talented like women, but that's all right. So there we go, ready.
And you know, Chris, I heard that the way you cook is you like to cook with wine, and sometimes you even put it in the food.
Sometimes I do. I guess it really just depends on what we're cooking, and that's, I think, what we got to figure out today. One of the most important things when we're going to get into the kitchen, the kitchen of your finances and cook a meal is, Craig, we got to know what meal are we going to make. So who here cooks meals for their family? Put meal in the chat. How many of you actually cook for your family? Because this is going to be really good for all of you. There we go. Holy cow. Look at that, Craig. A lot of people cook.
A lot of cooks.
All right, so here's a question for all of you. When you're getting ready to do a meal, what are how do you decide what the meal's gonna be? Is it just what you're in the mood for? Do you ever give any thought to, I wonder what the family would like? What would, I know when Larissa cooks meals at my house, it has nothing to do with what I want to eat. It all has to do with what Vivi wants. If Vivi wants macaroni and cheese, we're eating macaroni and cheese. And if Vivi wants pizza, guess what we're eating? Pizza. But on rare occasions, she doesn't ask Vivi, and then it's just the imagination. I think that's the most beautiful thing about finances, and specifically about the infinite banking concepts, which is the concept we're going to be talking about today. And the infinite banking concept is a process. And the reason we came up with this episode is cooking is also a process. You can't just show up and just be like, I'm going to cook and not have a plan. You need to know what the meal is. What flavors do you want? You want to sprinkle it with some paprika, you want some mustard, some hot mustard. I'm a spicy kind of guy. You want some curry in there. You got to pick the flavor for the meal. So Craig, when we're getting into this, we got Felix likes garlic. Garlic is supposed to be pretty good for you, but you know what? You're going to have a toothbrush after that. So don't forget that toothbrush. We got to think about what we're going to cook today. And it doesn't have to be any one thing. So Craig, what are some of the things that you think we should talk about cooking today?
Well, I know from chatting with folks about this process we help folks with, or sometimes people come and they have a flavor of debt. It's like, I'm going to cook a meal around how to get out of debt, or I'm going to cook a meal around how to invest. So there's a lot of different things that we can talk about, but I'm kind of curious too here. Yeah, Shauna says retirement could be major purchases. I mean, I'm sure a lot of folks here today drive cars. And
who here does not drive a car? Put I in the chat. We probably won't get anybody. Good.
There's a couple.
We have a couple. Edna doesn't drive. Okay. Christian, Alexis. All right. So we did have a couple. Awesome. Thank you for putting that in there. I didn't think we would have any. All right. So that one's out for them. So they're not hungry for a car. So that's not going to be on the menu for them. But that's the beauty, right? Someone had mentioned we just go out for dinner. So when you go out for dinner, that cook doesn't just have one meal. That cook has a menu. And that's what we've got here too. In the financial kitchen, you have a menu, and we can pick from that menu. Maybe your menu today is paying off debts. Great. And then maybe it's investing. Maybe it's buying some cars and using them to rent out or on Turo, just like Shane was talking about in that video we played here. I mean, maybe you want to invest in stocks when they go down. Maybe you want to invest in real estate or do private lending. I mean, listen, the menu is full in this restaurant. But the thing we got to get really specific about, when we come up with what it is we want to cook in our financial kitchen, we got to figure out what ingredients we're going to need. And I think it's really important when we talk about ingredients, you must first know exactly what it is you want. So I know, how many of you have ever baked a cake or done like corn muffins or chocolate chip cookies? Every one of those requires different ingredients, right? So you go through the process of thinking up what it is you want to cook. And usually this is a planning process. This is not something that you just show up in the kitchen and you just boom. Like, let's say you're cooking for a holiday, right? It's Thanksgiving or it's Christmas. You put some thought into this. So what I would like to do, Craig, is could we just go through, because we're going to make a whole bunch of things in the kitchen today, and we're going to have to put together a list of ingredients. So behind me here, I've got what we need to write down. So why don't you start telling me some of the ingredients we're going to need for this financial cooking experiment that we're going to go through. And thank God I'm not going to be the one doing cooking, because you would get a grilled cheese, you might get a PB and jelly sandwich, and ramen noodles. It's about all I'm capable of cooking. So with that being said, Craig, why don't you tell me what ingredients we need, because I'm not going to cook this thing.
Well, this is a bit dynamic, so I'm just going to throw a curveball at you because I didn't think about this ahead of time. But if you want a muffin, there's going to be some people that need a gluten-free muffin, some
Yeah,
people don't. And I was just thinking, aren't the different providers and insurance companies we work with, couldn't I pick like a gluten-free option and a non-gluten-free? I mean, there's differences between the companies. If
huge
I have a
difference.
gluten intolerance, I need to go with a certain company. So I think as we go through all these ingredients, we're going to have to think about what's the best company or restaurant, whatever you want to call the analogy, which one do we want to go to?
And even with
But
muffins, or, when I think of muffins, I think of banana muffins. I love banana muffins. But you know what I hate? I hate when someone serves me a banana muffin and it doesn't have walnuts in it. Like, how many of you like walnuts in your banana bread or your banana muffins? Like, it just makes it for me. But then I'm sure there's some folks on here that are allergic to tree nuts, like my daughter is, so we can't use the walnuts. We might have to make two different meals, and we might have to make sure that none of those ingredients touch. So you can see this can get complicated, and that is why the recipe book market is a huge market. There's a lot of people, probably people that have made millions and millions of dollars just making cookbooks and recipes for cookbooks. So today, the beauty is none of these recipes are going to cost you anything. You don't have to pay for any of these recipes. We're going to put them together for you, but we're going to show you how to bake this meal, to cook this meal for whatever it is you're hungry for today. And we're going to show you the inner workings, the do's and the don'ts. So we don't get any people with tree nuts. We don't get any gluten-free people that are going to kind of be like, I'd love to have that, but, and like the other people, some people would love to get all the money back for every car they buy driving home, but then some people are like, I don't drive. Maybe they live in New York City or a big metro and they're like, no need for a car here. It's pointless. So Craig, let's dive right into this.
all
And
right.
let's figure out some of the ingredients we need here.
Well, I mean, before we get the ingredients, we probably need to think about what we're cooking, right?
Okay, so let's say the first thing we're going to cook is, I would have to believe some of the folks on here have some debts that they'd like to pay off, because I know that's where I started. When I started, I had a lot of debt. I learned about the infinite banking concept, which involved changing one thing, and that was where my savings went first and adding one step. And I wanted to pay off debt. So I'd have to believe some of the folks in here want to pay off debt. So if we're going to pay off debt, what would you say some of the ingredients would be for paying off debt?
Well, I mean, I think we have to kind of list out what are those debts. We need to get clear about,
Okay.
what are our various debts? Do we have student loans? Do
So
we
we
have
would
car
know
loans?
types. Yeah. So let's
Yeah.
do types of debt.
Think we would want to know interest rates. What kind of interest
Yeah.
rates do we have on that debt?
So we'd want to know the interest rate on that debt and a percentage. Okay. What else?
I think we'd want to know the balances, how much of that, because we need to make sure we mix up the right portions here.
Yeah. I mean, come on. If you're making some muffins or making, just a nice roast, I mean, you just don't just start dumping pepper in or dumping flour in and be like, I think that's enough. Like, we kind of need to know how much we're talking about. So that would be the balances. What else?
Something else I was thinking about, a lot of folks come to us and they have these 0% cards. And I think it's good to know when you're kind of building out this debt meal is how many of those are at 0%? When do they turn to, when does that introductory period end and what does it go to? So just kind of understanding those intro periods because, some people get surprised when that rate changes. It goes from 0 to 29, you know.
I'm just going to call that promo rates. This is kind of like when you're talking about cooking. These are the factors that you got to get in there. I mean, especially if you're cooking for a group of people. I mean, gosh, you got to know if anybody's vegetarian, maybe some vegan folks, some gluten-free folks, and you got to know, is anyone allergic to anything? If you just serve a bunch of stuff and they start eating, and then all of a sudden someone starts turning blue, choking, and you forgot to ask them, hey, are you allergic to those walnuts and pecans? And they say, oh, you didn't tell me those were in here. Whoops. Or like the other day, I went to this country club for a meeting and I got this broccoli soup. Sounded great. I get it. I take a big bite of it because I was hungry, and it kind of just had this bacon taste. So I start sifting through it, and sure enough, they put bacon. Who puts bacon in that type of soup? It was just like one of those broccoli cheddar soups. I've never seen bacon in it, but hey, you know, they should have asked. What else?
I think we also need to consider, what's your cash flow?
Oh yeah. What is the budget?
Yeah, what's the budget?
So if you're going to make a big meal, my goodness, budget matters. I mean, are we going to Wegmans today? Are we going to DoorDash the stuff in? You know, budget matters on what ingredients we put in, because sometimes, you know, you can get away with using cheaper ingredients and it goes a long way. All right, what else?
Let's see here. I guess we'd also want to know kind of what's the goal? I mean, when do you want to get that debt paid off? How much?
Oh, yeah. How much time do we have to make this meal? I mean, is everybody showing up at 5? They showing up at 6? Do we want that credit card hanging around for a year, or we want that sucker gone in 4 months? I mean, these things matter. All right, so anything else on we're just kind of doing the menu here. So the first item on the menu is debt. So we got types of debt. We need to know what that is. You got the interest rate on those debts. You got the balance on the particular debt. The intro period or promo rates that might be on that particular debt. Because, hey, maybe it's, like you said, a 0% credit card. I mean, we might not need to pay that one off right away because we could save some money. We definitely need to know what the budget is. What's your cash flow? How much money can you save? And how quickly do you want to do this? I think we got them all. So if somebody was coming to my house and we were cooking a meal, if they like sent me an email and gave me these things up front, you think that might help me a little bit in cooking the meal?
It would. And there's one more ingredient I just thought about. Well, actually, Shauna put it in there, and I know she's got a really good point here, because she asked, are there any lump sum saved? Because how many folks out there have some debt, but they have the cash in their hand and they're reluctant to pay the debts off with the cash, thinking, well, if I do that, the money's gone forever.
Or let's go one step further. How many people do you think right now have money trapped in the walls of their house? Because housing is, I mean, all of our houses have gone up tremendously in value, but a lot of us got those low interest rate mortgages back, you know, during the pandemic of 2-3%. And now if we were to refi to cash out or take that money out, well, that now all of a sudden we're going to jump up to like a 7% interest rate. So lump sums, or I'm just going to call that, is there any hidden equity? Because we don't need to go in and ruin that mortgage. We could just do a HELOC. We could do a first lien HELOC. We could do just a normal second lien HELOC, but that's really important. Thanks, Shauna. All right. So that's debt.
Yeah, and I think the whole point is, you know, for everyone listening, you know, we're trying to make this fun, but at the same time, make sure you're taking notes, because when you meet with our team, if you have all of this stuff and you've documented it all, it's really going to make for a better strategy call, so we can help, because we'll be making that meal. You're bringing all these different requirements and ingredients of, hey, I'm gluten free. I want a dozen muffins. You know, these are all the things that we want to take to the cook. But when we know all of these things, then we can build a better solution for you. So make sure you take notes. If this is your situation and you want some help with that, then we can, you know, consider all of these things.
So folks, I know we're just trying to have some fun with this, but I really want you thinking, like, if you're in a kitchen and there's multiple cooks in there, maybe you got your family helping you cook, like, it's really important to know all these things. You might have it all stuffed in your head, but it'd be really helpful if you're cooking this meal, the paying off debt meal, that all the other cooks, or prep cooks, as we might call them, in the kitchen, they know what your ingredients are. You follow what I'm saying? So what I can, like, we're talking almost in parables, but, you know, we're talking about when you're on a call with one of us, with one of the money mentors, and you're discussing your meal, what it is you want to do. I want to pay off debt. Great. Well, these would be things that are really handy for us to know, because if we're going to help you kind of solve this problem, make this meal, that helps a lot. Well, let's keep moving on. So I'm going to go to the next page. What other things can we do? What other, like, I don't know, let's get a different meal. Let's change from the debt meal and let's go to a different meal. What do we want to talk about?
How about the investors out there?
Ooh, investors. How many investors do we have on here today? We got any investors? Stocks, bonds, mutual funds, real estate, collectibles, gold, silver. How many
We
of you
know,
invest money?
yeah, we know Shane's in Turo. We just saw that video.
Investing for ROI, Shauna, yeah,
Mhm.
she's into that investing. Maybe some forklifts in their mix. All right, so we got a bunch of people that are investing, real estate, we got Turo. All right, well, let's go through, let's put together the list of ingredients that we're gonna need for the investor who's looking to make a return on their investment. What are we gonna need to know?
Are they looking for cash flow or appreciation?
Okay, that's a good one. Are we looking for long-term appreciation or are we looking for cash flow? Do we need a monthly check to help our lifestyle?
Kind of thinking about, let's see.
Craig, can I take a stab at something before you say something? If I'm thinking
Yeah,
about appreciation or cash flow, I'm thinking about time horizon too. Okay, so if I'm going to make an investment and I'm going to use the infinite banking concept for it, if I'm going for appreciation, how long do I have to hit my desired appreciation? Or if I'm doing cash flow, same thing. How long do I want that cash flow to come in? And then I'm sorry, I got to go one more. Both of those things would factor in a thing called risk. How much risk am I willing to take? Like if I want a high cash flow with a low dollar amount of money, well, that requires you to take more risk. Well, what is your appetite for risk? Are you willing to, gamble a little bit to try to get that? And then if it doesn't go well, you got to be able to accept that and you got to be able to recover from that. So I think risk is a really important thing. So I'm just going to write risk profile. What is your risk profile? What else we got?
let's say the desired type of investment. So there's real estate, there's stocks, there's bonds, there's all sorts of Turo. What are you trying to do with your investment?
Yeah, so I'll just write real estate, stock, options. We have a bunch of people that use their infinite banking concept to trade options, maybe private lending. So we'll just write P, there we go, PL. All right. What are some other things you can think of?
What else would what would you start? What do you need to start this investment? So let's say you're a private lender, typically what kind of deals you want to get in, how much you want to put in, so how much do you need?
Yeah. Amount needed for the investment. Got it? What else? And audience, please fill in. Like, what are some of the things you think would need to be discussed or the ingredients that we would need to know to make this kind of a meal?
So Shauna says, is it sustainable year 2 and beyond? So if you set this up, are you going to be able to, keep that plan going for year 2 and beyond?
Yeah, I think that's important, especially when we're talking about a cash flow meal. It's
Mhm.
very important to know that cash flow, how likely is it that that cash flow will make it for the amount of time? And I love Mark said retirement benefits, but it's kind of the same thing. If you got a 401k or you got retirements, even if it's a defined benefit pension plan, that's going to pay you income. You're going to change from an accumulation phase, okay, so depreciation, and you're going to flip it over to what we would call a distribution phase. So I'm actually going to write that, distribution. And when we do that, we got to make sure that there's enough money to make the long haul. And if there's not, we might have to take on a little extra risk if you're okay with that, if you can handle the risk to get the cash flow you want or the return you want, or we might just have to dial back the cash flow to match the risk because it's always one or the other. Okay, what else?
Larry has a good point. He asks, is it passive or is it hands-on?
Active investments, which would be like real estate. I can't think of any more active investment than real estate because it's just a pain in the ass, or passive real estate investing in a syndication, investing in a fund, investing just be as a private lender where you just lend and you have somebody else doing the underwriting. I mean, because there is third parties that you can hire to do the underwriting on your real estate deal. And I think that's probably going to become a more and more popular thing because as we learn, as mistakes happen, we start saying, hey, maybe I should hire a professional to underwrite my deals. Maybe not a bad idea. It doesn't cost much, but there's nothing more expensive than making a mistake with investing. So it's always best to get that professional cook in your corner that knows how to make that meal. Because I listen, Craig, I think I'm going to say this right. Tiramisu, is that how you say that? Tiramisu, you know that like.
Yeah, when you said it, I had it.
Tiramisu. How do you say that, Mike? How do you say tiramisu?
Tiramisu.
Tiramisu.
That's that meal. I'm sure a bunch of you have had them. They got that like sugar on the top. It's like burned. Like
Oh, you're
that's
thinking
gotta
of
be
creme brulee.
creme brulee. I'm
And I've
screwing
got a
it up.
story about that later.
Creme brulee. That's what I was thinking of. Like
Yeah.
that's gonna be a really hard thing to make, I would think. So what's your story on that? We can get right into it.
Oh, if you want to hear the story now, I've got it for later, but I'm going to tell it now. So, and this is why ingredients matter. And this is a true story. Several years ago at a restaurant, we're celebrating a win and great meal. And all of a sudden, it's like dessert time, and I love a creme brulee. So I order the creme brulee, and some other people do too as well. And they drop it in front of me, and I take my spoon, and it goes right in and right into my mouth, and I spit it out about as fast as I put it in. So the first thing that should have been a clue is when you have creme brulee, does your spoon go right in?
Oh, it's
No,
creamy.
it's got that hard, crunchy thing you got to break through. Well, what they did in the kitchen is the chef put salt on top instead of sugar, and it didn't caramelize. And,
Oh,
and so it was all salt, it wasn't sugar. And so, oh my gosh. So, do you think that that meal was what I was looking for?
no.
So if someone came to us and they're trying to pay off debt and we built a system for them that didn't allow them to get cash value for 10 years, that's just like me having a creme brulee with salt on top. It
I
didn't
would say
taste good,
so.
it didn't work. I spit it out. It wasn't a tasty meal.
Anyone else have any serious stories like that? What do you do? Oh my goodness, look at Beverly's. What do you do when an unexpected guest shows up for
Ooh.
dinner? Ain't that some shit? When someone just pops over and you're like, oh, I didn't know you were popping over. What National Lampoon's Christmas Vacation, Uncle, what was his name? What was the
Oh,
uncle's
Mike knows. What was his name?
National Lampoon? Remember the uncle, the cousin
Yeah.
who just
Cousin
showed up?
Eddie. Cousin Eddie.
Cousin Eddie.
Cousin Eddie,
Yeah,
yeah, he shows up in the
Beverly. What
RV.
happens when Cousin Eddie shows up and he brings his kids, brings his spouse, and the damn dog? Yeah, you got to make some changes for that. And I like to think when we're talking about the investor ROI, the menu piece here, I like to think of that as being Uncle Sam, Mr. Taxman showing up for dinner.
Yeah,
He is
he's
never, ever, ever welcome, but he's in every single household during those dinner times. Yeah, man, that is a good one. Thank you for bringing that up.
yeah, it's a good
Let's
one.
see. Colleen said, let's see, we had three extra just invite themselves to Thanksgiving. Yeah, see, that happens. That happens. Lemon drop. Oh yeah, gosh. If you're gonna get into the cocktail part, we're gonna have to get to that part in a little bit, which I think we can. But do we got pretty much everything covered here? I mean,
I
I'm
think
gonna
I think
just
we're I think we're good. I mean, there's always going to be some side ones, but I think that's the bulk of it.
All right, well, let's go on for the menu because we're putting together our recipe list here, our ingredients. And now we're going to talk about major purchases. Somebody's looking to buy an investment property, or they're looking to buy a car or a tractor or a lawnmower. Major purchases. These are important, and these are something all of us do. And, this is probably with the infinite banking concepts, I would say this is one of those things that a lot of people they kind of don't use the infinite banking concept enough for this. I can't tell you how many of our clients that I talk to that are still financing or leasing their cars. Now, I get it, but if all of you add up what your car payment is, and if you were to look at the original amortization schedule and you looked at how much you're actually paying for that car, interest and principal, I promise you, that would become a lot more of a priority for you to pay. I mean, leasing's easy. You just add up every lease payment. And the average leasing, I just looked this up the other day, the average lease payment in this country is $720 and change. Think about that, $700 and change every month just to drive a car. And then when that lease term comes up, you hand it back in. And how often does the lease payment go down when you trade the car in to get a new one? I don't think ever. Cars get more expensive, payments go up, interest rates fluctuate. Like, how about that? That's exactly it. Never. So when we're thinking about this, major purchases, I like to call this self-banking because self-banking is a pretty easy way to kind of articulate this. Like instead of using somebody else's bank, we're just going to use our own bank. We're going to create our own banking system. And it takes time. It's like when you're cooking this one, I can tell you one of the big things that we need to account for is time. So I'm going to actually write time horizon. Because if I'm looking out there to go get myself a car and I don't want to finance that car, well, I got to save up. So I need a time horizon, a runway, if you will, to save up enough money to get to the point where I can actually go pay cash for that car. But you see, I'm gonna pay cash, but I'm gonna actually take a loan from my bank. And then I'm gonna figure out can I just give a little example? So back a while ago, and this is quite some time ago, 5 years ago, my wife was pregnant with Vivi, and she mentioned this thing about a push gift. Well, we needed a new car for Larissa because at that time we were driving, his name was Big Red, who was a kind of beat up, used up old Ford F-150 that we used for our real estate business. And I wanted to get her something nice. So we'd been car shopping, and I'm like, hey, I can do double duty here. I need to get my wife a car, but I also got to do this push gift thing. So we showed up at the Porsche dealership. My buddy worked there, and he had just taken in a Porsche Cayenne hybrid. It was a Cayenne S hybrid on trade. And he says, yeah, we haven't even put it out on the lot. Like, we'll probably be able to give you a really good deal. So we worked this deal out on the car. And that deal always goes the same way, and I know all of you can agree with this. You sit down with the car salesman, or saleswoman, because there's plenty of women in that space, and you go back and forth, and you're negotiating. You tell them your price, or you tell them how much you want to pay a month. They get up, they go over to the credit person, the sales manager, or whoever. They come back, they slide a piece of paper over to you, and you're like, nope, we're still not there, man. I can't do that. All right, let me go back. They go back. This happens a couple times. They go back and forth with the credit manager. Shane knows all about this. He worked in the industry. And finally, it usually is something like this. They reluctantly slide the piece of paper over to you and they say, hey, this is our final and best. We're losing money on that car. How many of you have ever had that happen? This is our final and best offer. And then they always say, and we're losing money on that car. Right, Shane? Losing money on that car. There's no way they're losing money on the car. Maybe sometimes, but Deck said never. They're never losing money on the car. But anyway, I looked at that. I look at my wife. I look at it, and I'm like, all right, we'll take the car. He gets super excited. Then he grabs a giant stack of paperwork, and he pushes that over to me. I look at it. I say, what's this? He said, these are your credit applications. I said, oh. I push them back to him, and I said, we won't be needing them. We're going to be paying cash for this car. We're going to be taking a loan from our private bank. Now, that totally confused him, but it also pissed him off. With any of you in the car business, other than Shane, would understand that what I actually just did is took money out of that salesperson's pocket because they get paid on the financing as well. And that really pissed them off because I negotiated a good price. But you know what? I won. They lost. I'm the bank. Thou with the money, or thou with the gold, makes the rules. Anyway, stupid story. Let's keep going here. We need to know time horizon. We need that runway. What else we got?
I think we need to know how much that thing is going to cost us. How much do we need to finance?
Yeah, how much do we need? What's the cost? Okay. That's important with ingredients for sure. What else?
I think it's good to know traditionally how have you purchased those types of items? Have you financed them? Have you paid cash? Like, how have you done that in the past?
Okay. Just by a show of hands, how many of you actually pay cash for your vehicles? Put cash in the chat. I just want to see this. How many of you pay cash for cars? Okay. So we got Robert pays cash. We got a bunch of people that pays cash. Now let's go one step further. How many of you pay cash for the car, but you still make a monthly principal and interest payment? Put cash plus. How many of you pay cash for the car, but you still make a monthly principal and interest payment on that car? Put cash plus. Robert put sometimes. No. Okay. Carrie said cash plus. Now, I didn't give you the whole thing. I would be that person. I'm a cash plus person now. Shane's got it. Okay. Mohammed's got it. Pay attention to the people that just wrote cash plus, because they're in the wrong grade class right now. They need to be bumped up to the next grade because they're one step ahead, because what they're doing is they're being their own bank. Because they're paying themselves back. They're paying their private bank back with principal and interest. And by doing that, they're getting all the money back for every one of those cars they buy, drive, and own. But anyway, we got a lot of really cool stuff to go. And I'm looking at the time, and Craig, how time flies in the kitchen. So I want to kind of get into some of the other stuff, because we kind of, I'm just going to write down some of the other things we could do. So major purchases, we could do supplemental retirement could be on the menu, supplement retirement. And what I mean by that is some of you may not want to wait until 59 and a half to retire. But if you put all your money in 401ks, if you rely on pensions, guess when you're going to retire? 59 and a half. So some of you might want to retire at 50 or 43. I talked to a guy I knew the other day, and I said, what have you been up to? He's like, well, I'm retired. And I haven't talked to him in a while. I said, how long have you been retired? And he said, well, for 8 years. And I'm just doing the math in my head. And I'm like, wait a second. I knew he had a bunch of money saved in a 401k, but there's no way He was 59 and a half. And I said, how old were you when you retired? He said, 53. I said, good for you. So you think he knew something that other people don't know? Darn right. Anyway, so we got supplemental retirement. What's one more thing that we can put on this menu here?
I guess funding businesses too. I mean, it's kind of a major purchase, but I mean, it's, you know, when Shane talked about Turo, I'm sure he's using his policies in a business format where he buys his own cars for his Turo business.
Yeah, and I'll go one step further. So we're launching a company called PMC Wealth. It's a registered investment advisory that Brandon's going to run. And PMC Wealth is going to do financial advising the right way. But the thing about PMC Wealth is a very expensive company to start. So you know how we're funding PMC Wealth? Funding it with loans from my own private bank. And same thing with another company that all of you are going to hear about, but it's Pepe Le Pew for today. So Craig and I are doing that, and I'd have to believe some of what we are putting into that is funded by our private banking system. Okay, so we've got all of this. Now let's get into some fun stuff here, okay? Because now we've gone through, we know what's going to be on the menu. We know what we're going to cook. We also know what ingredients that we need to cook these. Craig, what do we need to know now? Like if we've got the ingredients, we know what we're going to cook, what's got to happen next?
Well, we got to go to the chef. We now know the meal we want. We've got some of the ingredients that we want, whether we're gluten-free, we want a dozen. We've got to go to the chef now. And so when we talk to the chef, we'll be able to clearly articulate all those things, whether I have debt, major purchases, supplemental retirement income, whatever it's going to be. But I have to give a warning. You know, there's some chefs out there, Chris, that you might be looking for a really sweet meal and they're going to substitute and put in some crap ingredients. Right?
I've been there. I mean, listen, like reputation means everything. How many of you go to a restaurant because you know that the cook or cooks are phenomenal? You know they're high paid. You know that they're a specialist in what they make. Like how many of you go to a restaurant for that specific thing because the cook is well known and you know they know how to make a hell of a meal? I'm gonna put a big hell yes. Like I go to the same restaurants, and the number one reason I go to those restaurants is the cook knows how to make my meal the exact way I want it. Like, isn't that an important thing? I think everybody on here is going to eventually catch up and be like, yeah, heck yeah. Well, that is important. So you picking who your chef is going to be for your financial menu here is going to be vitally important. Now, you got lots of options. I mean, you got your broke-ass brother-in-law who actually showed up unexpected to Thanksgiving. And now your broke-ass brother-in-law, I can't remember, Colleen, I think said had 3 show up. Your broke-ass brother-in-law is sitting there at the kitchen table being like, hey, who here needs to buy some life insurance? Oh, and by the way, who here needs some investments? I got some really good mutual funds. But you know damn well that your broke-ass brother-in-law is, well, in his name, broke. And not only that, you know that he or she jumps jobs. So how comfortable are you going to be going with that person? You see,
he's the guy that puts bacon in the broccoli soup.
That was definitely a broke-ass brother-in-law that put bacon in broccoli cheddar soup, man. Some of you are thinking, man, how did you not like that? Well, I don't eat bacon. I don't eat meat. So that would have been an important thing for the broke-ass brother-in-law to figure out. But anyway, back to this. The one thing I will always tell you is no matter what it is in life, no matter what you're seeking, what you're looking for, I think every one of you would want to go to the person who has the reputation of being the best. But let's go to the extreme. You have a little bit of a chest pain and it keeps getting worse. You're getting short of breath. You're realizing, hey, this might not just be a little thing. This might be a heart attack. And you gotta make quick decisions. So somebody says, where do you want to go? What hospital are we taking you to? Are you just going to say, take me to the cheapest hospital you can? Or take me to urgent care because it's cheaper? No. You're going to think deep and hard about that one person that you heard about who's a specialist. So I know in my neighborhood, there's this one doc. He does one surgery and one surgery exceptionally well. I know this doc has really nice cars and a beautiful house. So I know he does well. But I also know that he has literally done thousands of these heart surgeries because he is a heart surgeon. And that's the person I'd want to go to. So Craig, how about you? Would you want to go to the specialist who knows how to do one thing exceptionally well? Or do you want to go to the generalist over there at the urgent care when you're literally right in the midst of what you think is a heart attack? How many of you want to go to urgent care?
Specialist.
Yeah, I want the specialist. Does everybody else want the specialist? So I think it's really important to go to know where you're going to go and make sure that it's the specialist. And again, we're going back to the menu. That specialist is that cook in the kitchen of your favorite restaurant that knows exactly how to make a specific meal exceptionally well. So Craig, I'm going to let you kind of go into this a little bit because we've got some really unique ways of showing this, but I do want to throw a little hook into this, and that might be a little premature. So folks, we're going to show you some things that I don't think we've really ever shown anybody. I almost would say some of this is confidential, but we're going to show you some things, and we're going to show you how all these ingredients get put together into making this meal. But then I'm going to show you how we, as the surgeons, because that's what we are the utmost surgeons in what we do. We do one thing and we do it exceptionally well. But how we're actually going to agree to work for you for anywhere between 60 and 90% less than what you would pay the urgent care doctor, because we like you. So we're literally going to give you the best we got, and we're going to do that at a reduced pay of anywhere between 60 and 90%. Craig, do you want to take it from there and kind of show everybody how we do this? Because we're going to peel the curtain back on this kitchen.
Yeah, let's peel the curtain back and let's talk about some of the other specialists out there. And they may not be specialists with solving the debt problems or solving the major purchases or solving the investment things that you want to do. But what do we see some of the specialists doing in our industry if we're surgeons? You know, what are some of the things that they're doing? Well, they're building policies that maybe are more beneficial to them than the client.
See it all the time.
And we do see that a lot, and we hear a lot of different things, and so we're going to try to shine the light on some of those things that will help you identify when maybe you need to put the brakes on and say, this may not be the best thing for me, it might be the best thing for them.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
Cooking up wealth. Yeah, and before that, with everybody that's on here, I just want to do a quick housekeeping. If you have any questions as we get into this, because up to this point, we've just been kind of just helping you get ready for that call with your specialist, okay? So now we're going to really get behind the curtains, and we're going to show you some things that to be honest, we've never shown before. These are internal things that we designed so that we know how to make the best menu for our clients, but now we're going to show them to you, but we're going to also show you what it cost us. And I've never shown anybody this, ever. I don't even think I've showed my team, but I decided, why not? Let's be transparent. So we spent some time and energy putting together the numbers, the global numbers, to show you, here's what it has cost us over the period of time that we've been doing this. And I think that's going to wake a lot of you up. But the other thing too that I want to call out is, with this, we're going to ask everybody that's interested in, whatever it is we're talking about, whatever your financial goals are. If you want to book a call with us, we're going to put a link over in the chat. And if you want to set up a call, just click the link and then go in and pick whatever time works for you, because we basically have a bunch of times open, so you can pick and choose what's convenient. We don't have to play this game of going back and forth. Oh, what's good for you? Oh, no, got my kids' ball game. How about this? Nope, that doesn't work. You just pick the time that works. So we're going to put that link over in the chat. And what we're also going to throw over there is we're going to put over in the chat this thing that we created called a quick start guide, okay? And it's going to kind of go over the basic quick starts for what the infinite banking concept is. So we got to find that. So Shauna's on here. She's going to find quick start, and we're going to throw that over there. But with that being said, Craig, let's dive into this.
And one more just quick housekeeping thing is, when we're going through this, you may not recognize some of these terms, go ahead and ask questions, put those in the Q&A. We're fortunate enough to have Mike Samet here with us today. He's going to be monitoring that Q&A and answering your questions. For those of you that don't know Mike, he's one of our money mentors on the team. So he's been doing infinite banking, and so he's very well versed in all this. But put your questions in there. Michael help you get those answered.
And Shauna put the quick start up on there. I didn't think she'd find it that quick, but there it is, folks. Quick start guide is phenomenal. Make sure you click that link and download it. All right, let's dive in.
So we're going to jump into this, and this is just the disclaimer saying that we're building some of these models off of a certain age person, certain health assumptions. So as we're going through this, your numbers may not be exactly like this, but the principles will be. So let's jump through it. There's some different glossary. I'm going to jump over that. But a lot of the use cases that we're going to go through today is based on a 45-year-old male kind of standard health, non-tobacco rating. The policies that you will see, or the numbers from the policies that you're going to be viewing, are from mutual insurance companies. We're using the paid up additions to buy dividends. So these are just some of the ingredients inside of the policy that we're using to build those. And we're also using a $10,000 premium per year. Now, if you are trying to do debts, you're trying to do investing, your numbers might be much bigger than this. They might be much smaller than this, but this is just the kind of the way we built our use case for today. All right. So the first thing we're going to talk about is some of the different spices that we have as we're kind of building out that meal. And in terms of insurance policies and the whole life policy designs, there are others, but the three main we're going to focus on today would be what we call the base of the total premium. There's also something called a term rider that can be part of that premium. And then there's something called paid up additions. Now, different companies call this something, different, but generally speaking, this is a rider. The paid up additions is a rider that will help us get high cash value. I just want to ask the audience, have you ever talked to anybody about building whole life insurance policies for infinite banking, and they've told you that you can't get cash value out for the first 2 to 3 years? Anyone on the call today ever heard that? If you have, just say aye. Yes. And that's one of the things that, we oftentimes quote Will Rogers, and he's got a quote that says, the problem in America isn't so much what you don't know, it's what you think you know that just ain't so. And so we do hear a lot of folks coming to us saying, well, I want to do one of these infinite banking policies, but I've been told I can't get any cash value for the first 2 to 3 years. That's just not accurate. That's a specialist that's kind of either not understanding how to do their practice, or they're just reserving some of that because they want more commissions or they want more benefit for themselves as opposed to giving it up to you. So I don't know which one of those it would be, but it could be one of those or someone in between. So that's what the paid up additions is going to enable you to do, is get that cash value early in the process. Now, the base of the policy, a lot of people go, well, I want to minimize that as much as possible. Maybe that's the strategy, but we want to think about, are you building this for retirement? Are you building this for investing right now? Are you building this for getting out of debt? So all of these things are going to be kind of dependent upon you, your cash flow, the solution that you're trying to, or the problem you're trying to solve. But these are the ingredients. Now let's talk a little bit about how we may use those.
Craig, real quick before you do that, I want to make one thing that I guess I've never really said publicly, but
Okay.
the money that goes into the paid up additions rider, okay? A lot of times agents or advisors don't want to really talk too much about that because literally the commissions paid out on the paid up additions rider are anywhere between 94 and 96% less than the commissions that they would get by just selling you a base whole life.
Yeah, I think it's worth saying again, because maybe people don't pick up on that. So you're telling me that if most of your premium goes into PUA, you're giving up 80-90% of your commission?
Well, no, PUAs, if the money goes in PUAs, and I'm trying to be as accurate because it's a little different by company, but it's anywhere between 94 and 96% less than what they would get if they just did a base whole life.
Yeah. So
that's the reduction. That's how little, that's how big of a reduction the agent would have to take to put the money into the paid up addition versus the base.
Yep, absolutely. So let's talk about that structure, because there are what we call traditional whole life policies out there, and they may not be bad. It could be built for a certain purpose. But when you hear about a traditionally designed whole life policy, and these are the things that you'll hear, the Dave Ramseys of the world, oh, these things are garbage. Well, you're putting in, say, 10,000 in year one and you have no cash value. And then you put in another 10,000 in year two and you have 20,000 of premium and maybe you have no cash value. It takes a long time for those to actually start producing any sort of available cash value to use. The reason why is 100% of the premium is going to be based on that base portion of the premium. So this is where most of the commission comes from. Just like what Chris said, the paid up additions rider might be 2%. of the whole premium, whereas this might be 55, could be 60, 70, 80% commission on that. So if you put in 10,000, your commission could be 7,000, could be 5,000, could be 10,000, just depends on the company. All right. Now, I do want to address, Ernestine says, do I need to close my old traditional whole life policy?
Oh my gosh, no.
Yeah.
I'm going to next week, or I think maybe next week, one of these weeks, I'm going to show you something. I literally just got one of my illustrations from a regular off-the-shelf whole life that I took out when I was at New York Life. And it's 17 years old today. And I want to show all of you on one of these trainings, maybe I'll even do a YouTube, what an old whole life looks like, even if it's the base. Really, the biggest difference here is, folks, when we design these, remember, we're designing these to solve a problem today. And we need high early cash value. We want access to the money all up front. The biggest difference between a regular whole life off the shelf, a base, and then the high cash value policies that we're talking about designing and cooking up today is the way they're designed differs in the early cash value. And it also, what we've shown, and you'll see in a second, it also differs quite substantially on how much death benefit you have at the end.
Yep. So the point there, just to reiterate, is if you have a traditionally designed whole life policy, don't just go get rid of it. Don't just let someone replace it. Have someone on our team review that, because just like Chris said, if you've had it for a long time, it's probably efficient and certainly could be used. So those are something that we always want to take a little caution with. If someone's just going to tell you, get rid of it, cancel it, don't do that. Let's review it before you make any decisions on that. But what we need to recognize with traditional whole life policies, and why we're not setting those up to solve a debt solution or to solve help you invest with your policy or help you buy major purchases, finance those things you need in your life. It doesn't work because it has slow cash value growth. So think of a traditional whole life policy. The death benefit's going to be high. The cash value is going to grow very, very slowly. And the agent that set that up is going to have the highest possible commission available. So when you see traditional whole life policy, those are the three things that are kind of happening: high death benefit, slow cash value growth, and the highest agent commission design. All right, here's what it looks like. This is an example of a 45-year-old putting in $10,000 a year into a traditionally designed whole life policy. So you see this $10,000 in the annual premium. And then if we look over at the cash value for year one, it's zero. We have no money to use in the first year. The death benefit is $551,000. So we have a high death benefit related to that premium. Year two, we've now put in $20,000 into the whole life policy, and we have a whopping $326 of cash value to use. So you put in 20 and you have 326 to use. That's not the way we would design it for an infinite banking process, or for using it for debt, or using it for investing, because who wants to put 20 grand in and have 326 to use in 2 years? However, let's say that you had one of these and you set it up and it's been 20 years. Well, you're putting in your 10,000, your policy grows 17,000. So you're actually at the efficiency point. So it took you a long time to get there. That's why we're saying, don't just go get rid of your policies if you have them and you've had them for a long time. They could actually be efficient and very usable at that point. But you'll see that the cash value in this projected cash value column, it just grows slowly compared to the way we would traditionally build it. All right, so any questions? If you have any questions on that, put them in the Q&A, but this is just kind of your traditional whole life off the shelf, low cash value, high death benefit. Now let's take a look at a different design.
One before you get to the next one, somebody in here, there's two questions that I just answered,
Okay.
but one of these questions that just came in I thought was really good. It was Moni said, does everyone need life insurance? And I don't think I've ever been asked that question. The answer is no. But what if you don't have kids or a young family that would need it when you go or when you die? And I thought that was a great question, but Moni, I urge you to really pay attention now. So if this was the whole life policy you were buying and you didn't have a family or anything else that needed a death benefit, you could make a strong argument that this kind of doesn't make sense because there's no cash value in the beginning. It's lackluster cash value later, although it gets better over time, but you got to wait a long time. You'd be better off putting money somewhere else if you didn't care about the death benefit. But Moni, I want you to look at these next few examples that we show, and I want you to make that decision as to would it make sense to have this type of specially designed whole life insurance, even though I don't really need the death benefit? I think that's a really good question.
Yeah. Yeah. And to your point, Chris, I mean, this policy, and Shane even says this one's not exciting. It takes 17 years to be able to get as much in cash value as you put in premium. So by year 17, you've put in $170,000 of premium and your cash value is $172,000. So you've gained $2,000 over 17 years. So if you were using it for the purposes of cash value, it really isn't all that exciting. But let's now go take on a what we would call, a bank on your, be your own banker, whole life design, infinite banking. We're going to build a policy for infinite banking where we want that high cash value. So let's say we're taking.
There's a couple of people saying something goofy. So one person's saying, how do we see the visuals? Can everybody see the screen? It's kind of like salt and pepper shakers over this yellow thing. Okay, so Shane, you can see it. And can everybody hear us okay? All right, so if any of you are having trouble seeing what it is that's down here or hearing it, log out and log back in. It's definitely on your end.
Okay, cool. Good. Yep, looks like everyone's. Yeah, and these are the salt and pepper shakers. And so now what we're doing is we're taking all those ingredients off of the spice rack. And what we're going to do is take that same $10,000 that I just showed you, and we're going to take 25%. So we're going to dump that into total premium. So 25%, and then 73.5% of paid up additions and 1.5% of term rider. Before we go on, someone might go, why in the world are you putting a term rider into your whole life policy? Well, there's some different rules called the modified endowment contract that the IRS has. And just to simplify it just says you have to have a certain amount of death benefit in relation to the amount of money that you're putting into the policy. And if you exceed those guidelines, it will be taxable. So in some of our designs, when we're driving higher cash value, we need to sprinkle in a little bit of term insurance to satisfy the IRS. That's on for, let's say, 7 years, could be on for 10 years. And in some designs, we might keep it on longer because we're trying to accomplish a certain goal. But there's a big difference between how we're designing this policy versus the first one I showed you, which was 100% base. Most of our premium is going into that paid up additions rider, and that's where you're going to see the cash value difference. So let's go on. And before we do that, just kind of looking at the scales again. So in the design we're talking about, we're going to have a lower death benefit, high early cash value, and the agent commission is lower. So you'll start to see in the industry, there's this pull between, someone that wants to create a traditionally designed whole life policy because the commissions are great, the death benefit's high, the cash value is low, bad for you. So there's some push and pull going on here based on what are you really trying to accomplish with this policy. If you're trying to finance things, that traditionally designed whole life policy from the start is not going to be your best option. So this is why we designed it the way we do. Okay, so now we're looking at another policy design where we're still putting in that same $10,000. And remember, we're putting in about 73% in paid up additions, 1.5% term, and about 25% base. Well, look at what happens. We put that 10,000 in. Instead of having zero, we now have access to $7,327 of cash value. So do you see the difference here? A lot more cash value because of we're putting that bigger chunk of the premium into the paid up additions. Do you see also that the death benefit is not $551,000, but it's $236,000? That's a pretty big difference. So you can just start to see that based on those different ingredients we dump into the premiums and how we split those premiums up and how we build this policy, you can have a completely different view of how this whole life policy is going to work. Instead of it breaking even in 17 years, it's breaking even in, between years 7 and 8. By year 4, we're putting in $10,000 and we grew $10,210 because of all the previous year's compounding. So this is what we're talking about, where we can use this to finance. We can borrow, let's say at the end of year 4, we want to borrow $30,000 to go buy a car. Great. Go borrow your $30,000 to buy your car. And then, just as Chris was mentioning, make a payment back to your own system. So all of this growth that you're seeing in this policy is going to continue uninterrupted while you're leveraging that money to go buy the car and make payments back to yourself. So this is why this type of a design would solve your problem if you're trying to buy a car or if you're trying to pay down debts versus the traditionally designed whole life policy. All right. So we have any questions on this? All right.
Think so.
Okay, so I'm going to keep going then. So when we start talking about agent commissions, and this is kind of what Chris alluded to earlier, we're going to pull the curtain back and show you some of our numbers. But when we're talking about commissions, if the commissions are lower, that means the cash value in the policy is typically going to be higher. If the commissions are high, your cash value is going to be low. So when you come to a specialist and you're trying to pay off debt, or you're trying to purchase and finance a car, or I saw someone was looking to buy a tractor earlier, or if you're trying to use the money for investing, which one of these scales do you want to be on? Do you want the commission for the agent to be lower and your cash value to be higher? Or do you want the agent's commission to be higher while your cash value is low? Shane's voting for the top one. Anyone else? Anyone else want the top one versus the bottom one? Yep. Looks like a lot of people are for the top. And as a licensed insurance agent, and Chris, I'm sure you would pick the same one, I also want the top one, because we want to build these policies so that you can get the high cash value, so that you can practice infinite banking, so you can finance your cars, so you can pay your debt off, so you can do investing. That's what we do. Now, this next slide, this is our numbers. Last year, and this is just based on our numbers from last year that we were crunching, our team gave up 72% in commissions based on how we design policies.
So folks, what this is showing, and there was a lot of math behind that we didn't want to show you, but we went through all of our commission statements and we figured out over the last year, like, how much in commissions did we give up? And we had to kind of make an assumption that the majority of our policies are like the one Craig just showed, 75-25, which is, if you do a blend, it's probably pretty close. That was exactly how much in commissions we gave up. Now think about that. If you were a company, would you want to give that much money up? I don't think so. Like, and nor do we, but this is just what it takes. So, we understand the only way to make this work, the only way is somebody's got to give so somebody else gets. And oftentimes when I look at this, I'm like, shit. I look at it and I'm like, was it really that much? Because obviously we just don't look at these numbers. This isn't a number that we focus on. We're not like, oh, what could we have made? We don't even look at that. Mike, I know, when you're designing policies, do you ever like start crunching the numbers, be like, wow, maybe if I do this, I could make more in commission?
Never. It's all about the client. I don't care about the commissions at all.
Because the simple fact of the matter is, I mean, if you were in our business and you looked at that number, that's just, that's what we gave up right there, right, Craig, over the time?
That's what we gave up in commissions.
That's what we gave up. I mean, a lot of the other competitors out there, like, they won't do that in their whole existence. So like, when they look at it, you have to have an abundant mindset. But the reason we are able to give that much up is because if we give, we get. When we do right by the clients, like Mike said, he never sits there and does a policy design that benefits him. He does it to solve the problem. He puts the ingredients in, then he knows what the recipe is. He just knows. And we're going to talk about that. Somebody was asking, hey, why would I have a 60-40 versus a 75-25 or vice versa, the design? And there's a whole formula that we've created for that particular need. And that's why we started today. But that is just what we gave up. Okay, I'm not bragging or anything else, and this isn't just 1 year. This is over a period of time, but that's a lot of money. And I don't care who you are, like, that's never not going to be a number that you would remember, but that's just what we gave up, 72%. So look at your job or your business, cut your salary or your pay by 72%. Would you be willing to do that to solve somebody else's problem? You don't have to answer. I already know the answer. Is 99.9% of the people out there just simply couldn't. Well, I would love to, but I can't. I wouldn't be able to afford to live. I wouldn't be able to afford to take care of my family. But if you started a company that was built on these metrics, it was built on already factoring in that you have to give to get, it would be all just business. It would just be how it works. And that's how we were able to do it. So hopefully you guys enjoyed that. We've never shown this. I mean, I did a video on YouTube how I lost 534,000 on IBC, but like this is the real story right here, folks.
If we wanted to make money on commissions, we'd sell IULs.
Yeah, somebody else asked about that. So what's the difference between a specially designed whole life and an IUL? Well, I mean, yeah, right there. If we wanted to make more in commissions, we would be an IBC. We would definitely be an IUL shop. And we've seen a lot of people in our industry go from like doing it the right way, like the Nelson Nash way, designing policies, you know, using whole life policies like we've shown. And we've seen them take the bait and go over there and start selling IULs saying that they're the best thing. Folks, that is 1,000%, not even 100%. That's 1,000% because they make more money. I had this guy at an event I spoke at. He's got a software company and they only sell IULs. And he came up to me and I didn't even know this guy. So he comes up to me and instantly he's like, oh, we should start working together. You should start doing IULs and using it here and you'll make way more money. I said, dude, right there, you just disqualified yourself from any further conversations. You think I'm motivated by money. You think I'm motivated because you're telling me that I make more with an IUL. You are, the only reason you make more with an IUL, asshole, is because your clients are getting less. End of story. Period. You put the risk on the client and you take it off of the insurance company, which is why the insurance company can pay you a higher commission on IULs. I don't mean to beat up IULs, but I'll do it for days if I have to. But what is the difference? Everything's the difference between an IUL and a specially designed whole life. But let's continue on before we run out of time because we want to make sure we show you the different models that we come up with, the recipes that we've created, the creme brulee.
Yeah. Yeah. So we already did the creme brulee story. And instead of having that caramelized sugar on the top, it was mushy salt. And so the ingredients do matter. And I don't want people getting stuck on, hey, I want a 60-40 or I want a 75-25 or I want a 70-30. There's so many other things that go into the design. And so the important thing is share your objective, share your specific story, your specific numbers. Let folks like our team, like Mike, myself, Chris, you know, we will design that policy to solve that particular problem.
And we're going to put a link up right now in the chat, like I mentioned earlier. Shauna or Mike, can you throw the link up there so people can book a call with one of our money mentors and we can go through what problem we're solving for them and how that would look. And this is another thing, folks, that I was reluctant to show. And we decided, Craig and I, that we would show this. This was designed internally. This literally was designed so that we could take this back to one of the insurance companies we work with and tell them, hey, here's how you stack up against everybody else. But compliance reasons, we had to eliminate all the company names from the top. But Craig, like, I'm still surprised we're showing this, but this is really good because this is being very transparent in this kitchen.
Yeah, and it's going to, in a few more slides, we're going to really make another point here, but I'm going to ask the audience, if you had the option between company A, B, C, D, or E, and you were putting in $10,000 of premium, which one of these companies would you want your policy with? Now, the green, I did it to make it easy. The green is showing which one has the highest numbers. So for everyone out there, and it's a little bit of a trick question.
It is, and the numbers are very close. If you look carefully, like line by line, like they're not far off because these are all the same design as he showed. It's the Bucky Doe example, but these are just different companies that we use in, you know, and it's very important. But there's, yeah. Anyway, I'm going to leave it here because this is definitely a trick question.
I mean, it's interesting that, you know, B starts off strong and then C comes in for a while and then B takes over again, and at the very end, you know, E comes in with higher cash value year 30. So it's just interesting to see kind of the push and pull of the different companies. But a lot of people are saying, hey, I'd take B. All right, well, let's move on. So that's, and to your point, Chris, I mean, they are very close, but there are some leaders. Now, what if we were doing it just by death benefit? If we were looking at just the death benefit between company A, B, C, D, and E, now which company do you want? I mean, in the numbers, I mean, it's 10,000 premium and one company, you know, D over here, they've got 264,000 of death benefit in year one versus, another company has 157 in death benefit. But remember, B had higher cash value than D. So you start to see there's some push and pull and there's some different things here. But yeah, wouldn't it be great if we could have the cash value of B and the death benefit of D? Well, I don't think that you're going to be able to mix those two together that way. But this is why we as the cooks know that, hey, in your case, based on what you're wanting to do, and maybe even some of your lifestyle, or it might even be your health issues, we already know that company E might be better than company A. Or we might know that company E, based on what you're trying to do, is going to be better than B. And so this comes down to where you need to work with us and we need to work with you to understand exactly what your situation is so we can get you in the right column of A, B, C, or D, or E, and then put the right ingredients into that policy to make it the best. So it sounds like overall, most people would want the cash value of B and the death benefit of D. But let's take a look at something else here. Another analogy, and Chris, I know you're not a meat eater, but for those of you, what's that?
I'm going to close my eyes.
Yeah, Chris is going to close his eyes because for those of you that eat beef, there's something called corn-fed beef, and then there's the grass-fed and the finished, grass-fed, grass-finished beef. And a lot of times people are looking at, well, which one's better? I bet if you go to most restaurants, you're probably getting corn-fed beef because it's lower cost. It's tender and juicy because it's got more fat in it, but you also get higher saturated fat. And then you look at the grass-fed, grass-finished. It's leaner, they claim it has higher omega-3s in it, it's more expensive. But at the end of the day, if you just look at a steak is a steak. And it's kind of like what we just did. We just looked at some different policies. A policy's a policy. But it does matter what's behind the scenes. What is the company? What are their riders? What do they, how do they work with certain medical conditions? Maybe you smoke, and this company would be better to work with. So the process and the company you're working with matters. And so we're not going to give you names, and Chris, I'm gonna need a little help here because I just started throwing this together, but company A, they're a great all-around company. We love working with them. They have some really flexible maximum paid up additions contributions inside of their policies that some other companies don't have that level of flexibility. So depending on what I hear in a strategy column, I go, yeah, I think company A might be a really good fit for you because of this and this and this.
Yeah, and let me kind of add on to this. So there was a question over there. Somebody was saying, Christy Van and myself say we have multiple policies. I have lots of policies, but it's taken me a decade to build up all my policies. And it wasn't because I'm trying to win a race by saying, hey, I got the most amount of policies. It was because as I've gone through life over this 10 years, my income has gone up. I've invested money. I've made more money from investing. I've used the infinite banking concept consistently and persistently like a religion, even though it's not, but I have. And because of that, I've taken back the banking functions in my life. I no longer need banks for just about anything in my life when it comes to borrowing. I finance everything in my life. Therefore, all the money that I used to give away for car payments and mortgages and all these things, that money, I still make those payments, but it all comes back to me. That means I have more capital coming into my life. As more capital comes in, I need more policies. Think of a bank. A bank has multiple branch offices, even in the same little town. You'll find a Bank of America office, like a little branch office on one corner, and then not even a mile down the street, there's another one. You're like, well, that's weird. Well, it's because it gives them the ability to raise more capital, be more convenient. So with the policies, as you build your capital base, as you continue funding your banking system, each policy is built with a maximum funding allowed. So when I first started a long time ago, my first policy was $240 a month. How long do you think it took me to max that policy out? And I could put no more than $240 a month in it. So what did I do? I opened a second policy. That one was for $560. That's the one I'm going to show in that YouTube video from New York Life. Then I maxed that one out, and it got easier, and I started making more money. And then I did the next one, which was $1,000, and I just kept going up and up and up. But here's the important thing that I want to bring over to this company comparison. As I've added policies on in my life, again, it's not a race. It's taken me 10 years to do what I've done. Okay, as I've done that, I've also used different companies because each of the companies have different pros and cons. So for example, company A, Nobody said company A when we asked which one you would pick. It wasn't that their numbers were bad. They just weren't the highest throughout the entire thing. And they never had a period where they were the highest. But what you don't know is that company A has the lowest loan interest rate. So when you're using your own private banking system, the policy, the loan interest rate can make a difference depending on how you're using it. So again, going back to the menu and going back to the ingredients determine not only the company, but also the design we use. So I have company A, and you know what I love about them is they have one of the highest guaranteed interest rates in the industry. They have one of the lowest loan interest rates on the loans that I take out. They are a solid performer with solid ratings, and they 100% support IBC. I know all the people at the company, and they're a very good company to work with, but nobody chose that company. So that's one of mine. Company B, let me keep going, is the one that you all chose. No surprise. It's probably the second, like when we look at our volume, it's the number 2 company we use. But although from the surface, when you looked at the numbers, it had the highest cash values, it was like the reigning champ, but we'll show you the numbers again. It has the lowest guaranteed interest rate out of the bunch. So they are the lowest guaranteed interest rate. So if for some reason the insurance companies all decided to stop paying dividends, which none of them will, but they, let's just pretend they did, the guaranteed interest rate becomes very important. And company B has the lowest guaranteed interest rate, the highest loan interest rate out of all the companies we work with, and a pro to them is they have very flexible premium designs. We can do more with company B when we're designing it than any of the other companies, with the exception of maybe company, I can't remember if it's D or E. And then they have the highest early cash value by not much, but by a little bit. Craig, I'm trying to remember which one company C was, but direct recognition. So company C, I do know who that is. Company C in the industry is probably one of the most used mutually owned insurance companies, but a lot of people that don't understand direct versus non-direct recognition and the impact that it has, which we can show you at the end if you stay with us. I have one policy with company C. And that one policy, guess what, Craig? What do I not do with company C's policy?
You probably don't take loans and keep them out a long time.
No, I do not. I use company C literally as a cash hoard. They have a great dividend. They have flexible designs, but I literally put money in company C's policy and I just leave the cash in. I have not taken a loan yet, and I took that policy out 2 years ago, I believe, and I still haven't taken a single loan, which is not what we teach. But you see, I understand the design and I understand the companies. Company D is policy loans after year 1. So that pretty much rules that company out. I used to use company D a lot. I own two or three policies from company D, and they are the most difficult company out of all of them to work with. Although by the numbers, they look pretty freaking good in most cases. And you can't take loans in the first year with that company. And company E is kind of like, I don't know, the black sheep, if you will. It's the smallest of the mutuals we deal with. They are the most flexible. They have the best underwriting. They've got a lot of pros, but they don't really like knock it out of the park against the other carriers. So it's like when you use company E, which I own a company E policy as well, I use that for a specific need, and I just wanted a solid performer with a high guaranteed interest rate, with a low loan interest rate, and that checked all the boxes. So when we go back and we look at what everybody put in here in terms of that, now let me ask everybody a question. How many of you want to know all of that? Right? How many of you want to do all the homework, all the research, all the work to know everything about every one of these companies? I bet you the answer is, well, you got one said yes, but I bet you the answer would probably be resoundingly no. I want a specialist who knows everything there is to know about all these companies, that understands my needs and goals very explicitly, and can recommend which company works the best for my specific needs and goals. All right, what else we got?
Well,
Craig?
and Chris, I guess it's no different than going back to your analogy of the cardiologist, the heart surgeon. I mean, we're never going to know as much as they do about the tools and the procedures they do, but you know that you want to go to the best one. So
yeah, like I'm laying on the table, I'm having a heart attack, and the doc's coming over wanting to put me, say, hold on, doc, hold on. Before you put me to sleep, can you show me the scalpel? What is that? What about that other one? What's that thing over on the table? Hey, you using this brand? Because I read about this brand. Hey, that stuff you're going to use to put me to sleep, like, does that have this in it or that in it? Is that good for me? Am I going to wake up groggy? Like, what are the things, like, did you sit there? No. You're like, fix my heart. Whatever you got to do, doc, I'm trusting you. You're the expert. You're the specialist. You've done this thousands of times. fix my heart and let me wake up for my family.
Yep.
This is the same thing.
And there's a lot of other stuff we could have put in here, but it gets to the point where I think what we're trying to express to everyone is we know the ins and outs of all A, B, C, D, and E, and have worked with them for a long time and have, we all have multiple policies across multiple carriers. And so when we're talking with you about your specific issue, we can figure out, I think B might be the way for you, or maybe E is the way for you to go. So just want to kind of share some of those different strategies just based on the columns. A lot of people will look at, well, I want the highest cash value. Well, maybe not, because you have some other considerations we need to put in place. So maybe B isn't the best for you.
Somebody earlier had asked me about 60-40 versus the other designs. Just so you know, I have, out of my 14 policies, I think more than half of them are 60-40s. And the reason for that, okay, is not because 60-40 is the best. 60-40 is the best for specific needs and goals. But if you do dump-ins into the policy, it changes. So whoever had that question about the 60-40, my next question would always be, did you do a dump-in? And if the answer was no, what was the need for what was your problem we were solving with this? And then I would take that. Again, I'm asking your ingredients, okay? I'm asking what menu item you want, then what ingredients we know have to go into that. And then I'm gonna use the best ingredients and the best company to solve your particular problem. Now, I can't speak for other people. I can only speak for my team, but that's how we train them. There is literally, and we audit this, just so you all know, Mike knows, I mean, sometimes I ask Mike, hey, how did you come up with this design? I'm very direct and blunt. I'm just like, why did you pick this design? Kind of asshole-ish. And Mike, like in the last one, put me in my place. He's like, well, I picked this design because it wasn't, in my opinion, and based on what I read, it wasn't the right design for that particular client. He said to me, he said, that's because that is exactly what the client wanted, and the client researched it. And not only that, this client was an estate attorney. I mean, what was I to say? Perfect. The client did their due diligence. So to whoever had that question on 60-40, I don't know whether it was right or wrong decision, to go 60-40, but all I can tell you is I have lots of 60-40 policies. They work incredibly well. They might not be as good as a 75-25 or an 80-20 or one of those designs in the early year or two, but I will tell you, it is one of the most consistent performers, but it is not our number one policy design that we use anymore, unless somebody is using it with a dump-in, and then that is probably, wouldn't you say that's probably number one with dump-ins? It varies, depends on the metrics, but anyway, didn't want to get too deep. Like, again, it gets complicated, but you just sometimes just have to have blind faith and understand that what we're designing, folks, if you're doing it with this team right here, one thing I will tell you is there are checks and balances to make sure that that design is exactly the best design for your needs and goals. And we spend extensive time training all of our mentors how to determine that, how to figure that out, and how to make sure it's right. Because we don't ever want to have a situation where another agent looks at it and is like, why would you design that? Because you know what? We look at too many policy designs from other people that said, oh, I'm an IBC person. Yeah, we can do IBC. And these assholes don't even know what the hell they're doing. We look at the design and we're like, what in the world is this? And then sometimes I got to look at the client. I got to be like, when you looked at this illustration and you saw that you only had 30% of your cash value available, that didn't raise a red flag. You didn't start asking yourself, like, I wonder if this is the right one, but they went ahead with it. So I can only speak for us, but I will tell you, we will go to the end of the world to make sure that our designs are the right ones for you.
Yeah, and those are really good points. And the other thing I'd say on a 60-40 that sometimes we'll increase that base, which means 40% is the base, because a lot of these insurance companies will allow you to add more paid up additions, on that base number. So let's say, for example, my base is $5,000. Some companies will say, well, you can do up to 3 times that in paid up additions, on and on and on. So sometimes by changing that design to a 60-40 versus a 75-25, it gives you the ability to keep putting more money in the policy for a longer period of time. So that's another design consideration. And that might be better for you than an 80-20. So anyway, there's a lot that goes into why we pick the design that we do. And a lot of it comes just from listening to what you're trying to accomplish. But Chris, I noticed there's a bunch of questions about dump-ins. People are asking, what is a dump-in?
Yeah, so a dump-in is, when we meet with somebody, so we're take this example right here. Somebody has the, they want to save $10,000 a year or $833 a month. It doesn't matter how you put it in. But then they say, then on the call, let's say let's use this, we're solving for debt. Like somebody wants to pay off their debt. And they're like, all right, I want to save $10,000 a year. Why are you saving that? Well, that's how much I was putting into the savings account. I'm just changing where it goes. But then we find out in the conversation that this particular client has been saving money in a savings account, and they have, let's just say, $50,000 sitting in a savings account earning less than 2%. So how many of you think you'd make more than 2% in this policy over the period of time? I think all of you should say it because the numbers are right there to prove that you're going to make more than 2%. So that client then says, hey, I want to take this 50 grand from my savings and I want to put it into this policy, but I only want to do that one time. All right. Maybe they say I want to do that twice, or we can do it any which way, but let's just pretend it's one time. They want to change where the money in their bank goes, and they want that money working for them at a higher interest rate in a tax-free environment, protected against judgments and liens. That's a dump-in. Now, when we do the dump-in, and actually, let me round this up. Let's say it's 100 grand. If somebody came to us and they wanted this policy, but they wanted 100 grand, and then they said to us, and I want a 90-10. Do you know what we would say to them? You can't have that, because you can't design a 90-10 with this. Contrary to what some of the other jokers out there that say, because me and Craig got in a massive debate with another IBC agent saying, oh, yes, you can. And you know how they were doing it? They were literally putting so much term insurance in the policy that in the later years, it almost ate itself alive. Like, it just did not make sense. So if you wanted to put 100 and then 10 in this particular example, dump 100 in and then do 10,000 a year, you would not be it would not be in your best interest to do a 75-25. We would design it, and it would more than likely, and I know you're not going to believe this, but it would more than likely be a 50-50. And then you would probably sit there and be like, well, wait a second, you said that's going to give you a higher commission. We're getting 50% of 10,000, not of the 100,000. The 100,000, remember, that's a reduced commission by roughly, depending on the company, but let's just say 96% reduction. So the majority of the money going into the policy, we're getting paid only a couple percent. And then the smaller amount, the 10,000, yes, we're getting paid on 50% of that as a commission. Okay. But still, when you blend it out, we're still giving up about the same as a 90-10, because the majority of it was the dump in, which is the biggest reduction you can get in a commission, is doing money into the PUA.
Yep.
I might have went down a bit of a rabbit hole, but that's
no, it's good. I think that clearly talked about what a dump-in is. So it's a way to kind of juice your policy from the beginning. I know we're at time, but do you think we want to go over the bonus content, or should we save that for another day?
Let's ask them. How many of you want to stick around for another 5 to 10 minutes to go into the bonus section, which is explaining direct versus non-direct. And this is being recorded, and we will put this on the YouTube channel. It'll make it there by the weekend.
Okay, so it sounds like we've got enough folks that want to stick around to see the bonus content. And this actually comes from a previous wealth webinar where we did a really big deep dive on policy loan, direct recognition, kind of how that's impacted. But I want to just kind of review that, because we did show one company that's direct recognition. So we want to talk about what that means. And so the insurance companies, the mutual insurance companies, don't all handle loans the same way. Think of it this way. You're going to hear two terms. One is going to be direct recognition. The other one is going to be called non-direct recognition. And the easiest way I can explain this is, think about a savings account. If you put $1,000 into a savings account, you're earning interest. As soon as you take that $1,000 out of the savings account, you're no longer earning interest. So the bank is directly recognizing that you took that money out. That's essentially what a direct recognition company will do, is if you pay your premiums, you build up cash value, and then you take a loan, what they're going to do is reduce your dividend crediting based on that loan being outstanding. So that's the biggest difference. Is a non-direct recognition, you can take loans and they won't recognize that you took a loan. In a direct recognition company, they are going to recognize that you took a loan, and your dividend will be impacted. And so it's just something to know. It doesn't mean they're necessarily good or bad. One's better than the other. There's actually almost holy wars over this conversation. So I'm not going to posit that this one's better than this one. It's just that you need to understand how they work and be able to effectively use those policies in the right way. So here's a company, a design where we put in 30,000 for the first 2 years, and then 10,000, then it went down to 3,000. But what I want to show you is if I build a policy and I don't take any loans, my cash value, and this is essentially just a ledger numbers to say the available cash value or the projected cash value at end of year 10 is $165,183. So I just want you to remember that number because I'm going to show you what happens if we take a loan in a direct recognition company. And I'm going to show you two things. One is we're not going to pay the loan back. We don't teach that, of course. And the second is what happens if you pay the loan back? Do you still have an impact cash value? All right, so our baseline is 165,183 at year 10. Everyone got that number? Use case number one, we're going to take a $25,000 loan from a direct recognition company and we're not going to pay the loan back. Now, this should be flashing. We do not recommend taking loans and not repaying your system. That's stealing from yourself. We don't teach that. I'm just showing this for the use case. So if anyone's watching this, sometimes people take things out of context and come back and beat me up on this. I am not saying take a loan and never pay it back. So I just want to make that clear. All right. So here's what it looks like. At the end of year 2, we're going to take a $25,000 loan. The reason it says $26,250 is because the interest was the $1,250 of interest was put onto the loan balance. All right. So we essentially took a loan at the end of year 2, and then the interest at the end of the year is tacked onto the principal. So remember that I showed you a cash value number of 165,000 at the end of year 10. Well, because we took that loan out and we never paid it back, we now have a net cash value of 120,965. Now, to be fair, we would need to add that loan balance back in to assume that we paid it if we paid it back. So just add 25,000 to this, and that's essentially the difference between what our cash value would have been. So this kind of shows the difference of what's going to happen when we take a loan in a non-direct recognition company. But I broke down the math for you here. So at the end of year 2, we took out a $25,000 loan. And what I'm showing you is the net cash value difference and the net death benefit difference between not taking the loan. So by year 10, we actually have a difference of about $19,000 in cash value and a $13,000 difference in death benefit because of the dividend crediting. And so the way this works out is with no loans by the end of year 10, we have a cash value of 165,000. So that was our baseline. If we take out a $25,000 loan at the end of year 10, we saw that our cash value is 120,965. So to be fair, I basically want to put that $25,000 back in there. So I'm just looking at the difference between the baseline and what we had. It's $44,000, but I want to add that $25,000 back in because we did get that benefit. So the difference or the impact of that direct recognition was about 19,218, somewhere in that ballpark. And we would have to be fair, we'd have to add the interest back in, but let's just say it's around $19,000. So the question would be, if you are going to be taking out a loan in a direct recognition company and you're not going to pay it back for a few years, you are going to have an impact. And this is just one example of what it could look like. In a non-direct recognition company, if you paid that loan back, your cash value would be 165,183. So that's the difference between direct recognition and non-direct recognition. So, and I'll just reiterate, we're not saying take a loan and never pay it back, but I just wanted to show kind of what happens to the cash value based on the dividend crediting. Any questions on that? I know it's a lot of math. And for all my analytics out there, I hope you like this. And for the folks that are probably glossing over it because they're not into all the numbers, I understand. So let's do use case 2, which is we're going to take a $25,000 loan from a direct recognition company, but we're going to do what we call a quick recycle, which means we're going to take a loan and then we're going to pay it back. And we're going to take another loan and we're going to pay it back. Okay. So how does this compare with scenario 1? If we take a $25,000 loan at the end of year 2, and then at year 3, we pay it back with our interest. And then we're going to take another $25,000 loan at year 4, and we're going to pay it back with interest. What's the impact at 10? At year 10, we're actually, instead of 19,000, the difference in cash value is about 3,668. So this is the dividend impact that you see in the policy. So not as severe. So when we take a loan, we pay it back, we take a loan, we pay it back. There's still going to be a little bit of an impact, but it's not as much. So just want to kind of run through that just so everyone knows that if you were to pick the cash value in that company A, B, C, D, and E, and you liked the one that was direct recognition, you just need to be aware that this is part of the ingredients that will make your meal taste different. All right.
Tiffany was
Chris.
saying, is not direct recognition more beneficial for the purpose of investment interests? I'm just going to give you my opinion. If you're using the infinite banking concepts, okay, which means you're putting money into the policy or taking the money out as a loan to solve a problem, pay off debt, buy something, invest, and then taking the interest or the money made from whatever that opportunity is that you put the money into and recycling it back to the policy as a loan repayment, then it's a lesser of an issue to go with a direct recognition. But by the math, as he just showed you, he nerded out on the math a little bit, but there's another video that really nerds out on it. You're always, by what we've found, going to be better off with a non-direct. So if you had the choice of direct versus non-direct, you'd always want to go non-direct if you're using this for the infinite banking concept. I have a direct recognition, and I'll be transparent. I have a policy with a direct recognition company solely because I live in a shitty state called New York. And here in New York, we literally have 3 companies that we can do business. Well, a couple more than that, but 3 that really work for the infinite banking concepts. And out of them, I just wanted a mix of all of them. And the policy that I set up with the direct recognition had a very specific need and goal, and that was to put money into this policy, let it grow over a period of time, and eventually use it for a remodel of one of our bathrooms in our house, which would be put the money into the policy, let it build up. Like, let's say it's 70 grand. I don't know what a bathroom remodel costs, but take the loan, pay for the bathroom remodel, and then immediately repay the loan back and just let it keep growing. So think of my direct recognition policy as literally like a forced savings account that is just built to hold money that I would normally hold in the bank account.
Yeah.
But if you don't live in New York, I probably would never, you'd never even hear about that company.
Yeah. So here
If
we
anyone
are.
wants one, sorry, Craig, one more thing. Celeste, thanks for liking the shirt. If anyone wants to get one of these, haters need hugs too. You might have some haters like I do. You can go on to chrisnaugle.com, go into the shop tab, and you can get yourself hoodies or sweatshirts. Heck, we even got hats that say haters need hugs too.
And I think on your shirt, Chris, you should put, but I'm not giving you one anyway.
But I'm not giving them. Yeah, exactly. Yeah, I kind of have gotten to that point. I used to be like, oh, they just need a hug. Now I'm like, no, I'm just going to punch you in the face if I see you. You're not getting a hug.
Yeah.
There are some mean ass people out there. I think everybody would agree.
Yeah. And it just, sometimes it doesn't matter, what you're trying to say or what you're trying to share. There's always some critic that's going to find something that you didn't say perfectly right.
Yeah.
Just like on your WTF session today about your Bill Clinton, there's always someone's got to jump in and just beat on it. But I'm like, it's okay. It's okay. But here we are. We're at the end. So thanks for sticking around. And really where we are now is if you want to make your reservations, we have a team of people that you can book a call with. We don't charge for that. We'll gather your details and just make sure you come with all the ingredients that you're looking for, and we can help prepare that meal. And so Shauna, maybe you can post the link and how people can book a call with our team. Because when you come to that call, we want to talk about these specific things. If you're tackling debt, just like we talked about, list out your debts, list out your balances, your interest rates, those promotion, 0% promotions, when do they end? If you're an investor, bring the details of what are you trying to do? How much do you want to lend? How much do you want to invest? What does a cash flow? Is it an appreciation? So just come with those details, and just like Mike says in the chat, if you have questions, we're there to help answer questions too. So you may not fully understand the whole process, and that's what we're here to do is help you with that. And I like what Chris always says, how we're not here to sell you anything, but if you decide this is right for you and you want to have help setting this up, then we will help you set it up. We'll help cook that meal for you. So with that said, I think we're at the end of our time together here. Appreciate you all sticking around. And so Chris, I'll hand it back to you.
All right. Well, with that being said, folks, thanks so very much for joining us for this awesome episode of the Wealth Webinar where we got to be the cooks in the kitchen, and we're hoping to make you a beautiful meal. So with that being said, we'll see you soon. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.